Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, covering everything from core fundamentals to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, head of investor relations at Focus Capital.
I'm Chad Schiller, founder at Focus Capital.
One of the most common things we hear from investors, both ours and others, are I've seen a lot of deals. How do I know which questions actually matter? Um, Today, we're going to talk about why asking better questions is more important than getting quick answers, and then why diligence is about downside, not just upside. So,
That's good.
um, there are some key question areas that I'd kind of like to structure this around. The first one is business plan, and the two key questions that I think that we should start with, and you can kind of go into why is what needs to happen for this deal to work, and which assumptions matter most. So let's start with that first one. What needs to happen for this deal to work? What kind of questions around that, and why is that an important question for investors to ask about a deal?
So let's back up one step here first. So you tell me I can just put the deck into ChatGPT and say, give me questions to ask, email the sponsor.
Yeah, we've
This
seen
happened
that.
before, yeah.
Yeah, not to call out any of our investors, current or potential, but this is the thing is that I mean, even taking 5 steps back, kind of
It
double
can
check.
help though to give you some framework.
It can, but if you're a brand new investor, speaking as
Where do you
like,
start?
yeah, where do you start? But then
Yeah,
also it's like, if you don't know where to start, that's okay. A
yeah,
good operator should be able to handhold you. My job here at Focus Capital is to have investor communication that's current investors and potential investors. And if
yeah,
you are a first time investor, my job is to make everything understandable for you. We don't need
yeah,
to use, acronyms, shop talk, all that stuff. Just come to me and
yeah,
say, hey, the first thing is like, I don't even know what questions to ask. How do I know that this is a good deal? And if someone's responsible, which we are, then I'll say, this is how we evaluate deals. Here's how our investors
yeah,
evaluate deals. And this is something we do. I can't speak for other firms, but like if you are evaluating a couple of different deals and we're one of those, I have in the past offered to say, hey, you can send me
yeah,
these
sure, yeah,
deals. I will review these and I'll tell you why I reviewed these, and then I can compare it to our deal. And then I'll let you know kind of like how I would make my decision. Obviously, I'm not a financial advisor, and I'm definitely not their financial advisor.
yeah.
But a good IR person, IR representative, will communicate that to investors, especially new or first time investors. Of it's okay to not know all the answers to the questions. And then that's why we're also having this podcast. All the questions that we go over today are going to be available in a PDF in our description box so people can download that. But I think the very first question that anyone should ask when evaluating any type of deal, real estate or otherwise, are what needs to happen for this deal to work?
Yeah. Even back a step is like, well, I'll have some investors that will ask me like, well, what questions should I be asked them I haven't asked already?
Hmm.
And they're just like openly admitting like they don't know all the answers, and they shouldn't, right? They're a passive investor or the operators, so that is an element of trust. They trust in us to tell them like, okay, here's the risk on this deal. Here's what you haven't asked yet, because really you're not looking. This is not a sale that we're trying to sell somebody on. It's really every investment is it can or cannot be the right fit for different people.
Hmm.
Is it a fit for you? Not a fit for your strategy and your goals, right?
Hmm.
So there's questions that we can guide them on what to ask, like, okay, tell me more about, like you said, what all can go wrong? And what can go wrong? Okay, maybe the PM company fails. Okay. Maybe
And by PM company, you
a
mean property
property
management.
management company.
Hmm.
Yeah. Maybe the market has a slowdown in jobs. Maybe there's more apartments being built, more
Hmm.
competition, more supply. Maybe there's a slowdown um, in wages somehow, right? What all could affect the revenue to not go up? What all could affect the expenses to go up? Tax increases, insurance increases, a lot of different factors that could be risks.
Yeah, and that's why I think the first question that anyone should ask, whether it's actually verbalized or they just ask themselves to answer it while looking through an investor prospectus or slide deck, is what needs to happen for this deal to work? Does it rely on X, Y, Z, and are those controllable variables, excuse me, or are they, completely out of mine and the operator's hands? And so that leads into kind of that second question of which assumptions matter most. Now, this is
Yeah,
not which assumptions matter most overall, which assumptions matter most for this deal. So this is dependent on hey, we think that this property is going to increase in value because UPS might be opening up a warehouse,
Yep.
might be doing this, might be bringing 6,000 jobs. This political cycle, XYZ candidate, it might be doing this. Like, if you're relying on those assumptions, and that is one of the major pillars of what needs to happen to make this deal work, that's incredibly risky versus
Yep.
our assumptions are, hey, if we maintain a 75% occupancy rate or higher, we're at a break even point. If we're at 82% or higher, we're at a profit point. And so it's like, and if the rolling occupancy rate is already at 89 to 90%, then you're like, okay, I even have some margin for that to dip down.
Yep.
And if we have a good, like you said, property management company, a good operator that is able to evaluate that property management company, if you're not a vertically integrated firm, then those are assumptions that, like, that's a good assumption to be able to base this whole investment thesis
Yep.
on.
Yeah, those are good. Those are great thoughts, actually. And I like what you said about like what's it take for this deal to actually work
Mhm,
to get the returns, and then on the flip side, what can it take for it to go wrong?
mhm.
So looking at maybe what are the two largest factors that most of the return is hinging on.
Yeah.
So is it hinging on an exit, like maybe cap rate compression potentially, that could inflate the value there? Is that what we're banking on here for the next 5 years?
Mhm.
What happens if you dial back the cap rate by 50 basis points or 1 full point? What actually happens there to the returns, right?
Yeah.
Or are you banking on 5 to 7% rent growth over the next 5 years when
Mhm.
we haven't seen it the last few years? Like that'd be probably one of the biggest tell signs
Yep.
is what's the rent growth factor, and knowing the average is probably 3% on a good year,
Mhm.
and other areas have had maybe 1 to no percent, but negative recently. So
Yeah. And
that'll be a big one.
I would say all your questions will fall into one of 5 categories, and we just kinda talked about one of them, which is the business plan overall. The second is what you just talked about is downside scenarios. The third category is debt and capital structure. Fourth is alignment and incentives, and fifth would be track record and relevance, and that has more to do with the operator. Sticking with that second section, because 'cause we've kinda covered business plan-wise, the downside scenarios, you already talked about, what if rent growth is slower? What if, expenses are higher? What if the exit environment changes? Those are 3 questions within the downside scenarios that I think that all investors should either ask themselves, or if it's already addressed in the deck, or ask the IR person. Ask the person that you are talking to at that firm that is asking for your capital. How have you considered this? What happens if this happens? Um, are there any other questions in that downside scenario that you think people can ask? Because obviously you can ask a whole plethora of questions, but what are the top line ones that, like, if someone doesn't have an answer to this question or hasn't already considered it, that should be a red flag?
For downsides, I think it's like, okay, what happens if the market takes a turn? What happens if there's more supply?
Mhm.
And what happens if you can't get your rent growth in your business plan?
Yep.
I mean,
And we can get
what are the
granular.
returns? Like, is it a break even then?
Mhm.
Is it, and you lose some money?
Yeah, exactly. I think that, and it's, again, similar to our last episode. It's a very important for us to address that this is not a comprehensive list of every question that you should ask, and we're trying to keep this more general because these are questions that can and should apply to every single investment. Now, there are going to be some specific ones, like especially when we get into the debt and capital structure of, like, there are some investments, some of our investments that are even like we assumed certain loans, and then there are some that it's like it's a loan origination, and so there are
Yeah.
different questions about those things. But keeping it broad and general, I think that those are probably the best questions to ask when it comes to the downside scenario. Moving into the debt and capital structure, I think that personally, 3 big questions that people should consider are uh, questions around fixed versus floating rate,
Yeah.
refinance exposure, and then term length and reserves. Do you want to kind of just briefly talk about what fixed versus floating rate is
Yeah.
and why that affects your investment?
Yeah, absolutely. So fixed versus floating. So fixed rate, essentially, you get a loan from a bank and your rate is the same for
Mhm,
the entire term, whether it's 3 years, 5 years, 10 years, 30 years, kind of like our home mortgages for the
mhm,
most part. A floating rate is basically a variable rate loan to where it's going to be varying. It can variable, and the variable can be determined by a certain index that is set by either the U.S. government, such as the federal funds rate, or set by other indexes called SOFR, et cetera. Right? There's different ways these to be variable based upon certain economic conditions. The challenge with that is that, as we saw back in 2022, is when the U.S. raised the funding rate uh, in 18 months, hardest ever happened before, more than double. That's when a lot of real estate people got in trouble. They bought deals on floating rate debt because they thought they'd be able to do their business plan and get in and get out in like 18 months, 2 years before the 3-year period expired, and then refinance to something else that was fixed. Well, guess what? That didn't happen. And now we have deals that are underwater by their operators. Now I've always used fixed rate debt personally.
Mhm.
I've always been very risk averse. Um, Not to say that floating rate debt does not have a tool, have a time for a tool
Mhm.
somewhere else, but it can be a good tool to use. But there's also ways you can mitigate risk with that tool if you chose to use it. But for the most part, fixed rate is a much lower risk option.
And I think a sub point to that, and especially something that we've also seen here, is that you could have multiple fixed rates loans. And so what is your average, rate across your spread? Because we have a property here where we have two fixed rate loans, and one is at a 3.53%, and then one is higher, so that the non float rate, but the rate between the two is closer to a 4 than a 3.53.
Yeah.
And so evaluate that, make sure that your operator is saying those things, because a lot of people would just try to sell, hey, we're assuming a loan at 3.53%, which is something that you can't get today, but they don't leave out this other loan that they're assuming and bury it in their PPM and things like that.
But I think going back to like the questions that LPs can ask when looking at a deal, asking what kind of debt is on the deal. That's a great question because the debt does carry one of the highest levels of risk there is.
Yep.
And if the operator were to say, "Oh, we have, we're doing bridge debt,"
Mhm.
bridge debt is pretty commonly known as variable rate debt. But
Mhm.
for the most part, it's always variable rate debt. It's meant to be a bridge, a short term to get over the hump, to get through some renovations or whatnot, to do something longer term, right? So I would dig in further if that is the case.
Yeah. I think that another thing to ask is, why? So for example, if someone were to ask you, why don't you do all cash deals? Why do you raise for a certain percentage, and then why do you do a bank loan for a certain percentage on your deals?
Yeah, if they were all cash, well, number one, you couldn't invest in our deal,
Mhm.
so would be good for you, but there wouldn't be the returns. Like it's all about leverage. Sometimes you have to have there's an amount of leverage that does make sense for these
Mhm.
deals. But most deals, if they're bought all cash, they might make between a 5 and 6% return overall on the deal. That's what the cap rates are, right?
Mhm.
So by using leverage with the bank's money is a lot cheaper than investor capital cost is, right? Cost capital. So if we can leverage, 67% from the bank at it's called 5%, well, we can give a much higher return to our investors by investing to our deals.
Yeah. The other two things that we talked about is refinance exposure and term length and reserves. I think that not every deal is going to get refinanced, but definitely considering those. And so that might not apply to every deal, but what would apply to every deal is there a chance of refinance? Is that part of the business plan? And then what is the exposure there? And then term length and reserves. We talked a little bit about this on our last podcast, but I wanted to give you the opportunity. To kind of tap into that on like how to consider term lengths, how to evaluate term lengths, and what are reserves? What are reserves used for?
Yeah, so different things there. So term length and reserve. So I'd say most deals that are syndicated for the most part have between a 4 to 6 year timeline
Mhm.
typically. There are some operators that may do longer time frame, which I actually love that personally. Gives you if you buy a deal and plan to hold it forever, then you can obviously withstand a lot of storms. But I'd be cautious on a deal that's like got a 2 or 3 year timeline because you have a lot less time for things to a lot less time to um to, to fix things if things aren't going right.
Yeah.
Like if the market's taking a dump, like you don't have a lot of time on your hands, right?
Yeah,
Uh,
from our last episode, we talk about risk mitigation. If it's a shorter term deal, you are assuming that a lot of things will go right off the bat,
Quicker.
and
Yeah.
nothing is going to go wrong, or little to nothing is going to go wrong. Because, like you said, if something were to go wrong, if you were to have headwinds instead of tailwinds, you don't have nearly as much time to correct those.
Yeah. I think for investors, especially newer ones, which is probably more focused for this episode lies, they've got to be they have to learn that this is not a quick game. Like
No.
you can't do that. You shouldn't be doing this with a 2 or 3 year exit consideration. If you plan for 5, 10 years, then you're in the right mindset because real estate is a long game. The goal here is not to get a quick flip and fast buck. The goal is to preserve your capital and grow it in a great investment that's lower risk. That's the whole idea here.
Yeah.
Saying it's tangent there, sorry, but
No.
reserves. Reserves again, you need to keep adequate reserves in the property. You should be asking them, okay, how many months of reserves do you have in the property? Are you reserving for capital expenditures? Are you reserving every month or every year a dollar amount per unit towards future capex, capital expenditure needs? So understanding that they're well capitalized should help you sleep at night, knowing that there's reserves and a lower chance for a capital call.
Yeah. Alignment and incentives. This is an important one, especially for syndications. So, how is the sponsor compensated, the GP, the operator, whatever nomenclature you want to use? And how did they get paid versus how do the LPs get paid? So, do you want to talk about how we structure our deals?
Yeah, yeah, sure. Yeah. I think for the most part, most sponsors will take a fee up front when they acquire the deal, which is pretty common. And that goes to pay for the company, the team, the work you put into look at all the deals, underwrite them, and perform the next 5 years on the property.
Mhm.
Beyond that point, typically there's a what's called a promote or earned interest towards the end of the 5 year life cycle, for example, to where the GP would share in that. But for the most part, along the way from day one until that we sell, the LPs, the ones that stand to gain majority of the profits,
Mhm.
and that's on purpose. And that way they're put first. They put the money in with us, and our job is to prove to them and work for them those next 5 years to manage the asset well.
Yeah, and we'll talk about preferred and what that is and how people can consider that, and actually an episode soon. But I think that to kind of wrap up this episode, that fifth category is track record and relevance, and this has mostly to do with the operator and not the deal itself. Is why experience should be specific and not generic. I think that there are a lot of operators that have, um, I even seen it where they are in one area, and by one area I don't even mean geographically. They might have had a good track record on commercial investment, commercial real estate, and that's a different game from multifamily. And so I think that track record and relevance is something to pay attention to, but you cannot hinge your entire assessment off of that because you should never um, base your current deal off of past performance because every deal is different.
Yep.
So, what is that balance? What is that balance of, and this is kind of hammering a nail on the head of how to evaluate an operator, but what weight should you put on specific experience, past performance, track record, and not relevance? And where should that fall on your list of priorities when it comes to evaluating a deal?
I think it falls towards the top. I do, but at the same time, like when I first started doing real estate investing, there was people that invested in me that I had done a couple deals on my own with before, but never with other investors. So there's people that will take a chance on you for their first time, your friends and family, people like that. But for the most part, I do think track record is really important because you need to have the experience to operate because operations are so key.
Mhm.
That's what makes the whole thing work. Everyone can go buy a property is pay the highest price for it. The real test is actually executing the business plan. That's the real test.
Yeah.
So I think the track record is showing that they've done several like kind deals similar to what you're going to invest in today.
Mhm.
So what wouldn't be that example would be, oh, they've done a maybe mobile home park purchase, they've done a land deal, they've bought a strip center, another new apartment complex.
Mhm. They've
They're all
done
very, very
parking
different.
lot structure,
Yeah,
they've done.
they're all very different. But have they done some of the same asset class multiple times? They've got the reps in. They've learned some lessons on their own. They've learned mistakes in the past, and they should be a better operator today because of that.
Mhm.
So that should give you some confidence to invest with them. Now, have ensuring requiring them to have like a certain number of exited deals. I can go either way on that because I don't feel like it's you need to look at, oh, well, have you had 10 exits on your track record here? Well, an exit may not always be the best business plan. What if your business plan is a hold in perpetuity and get tax benefits and refi 3 times the next 20 years?
Mhm.
Then we have misalignment there, right?
Yeah.
So that could be different. Now, if they have exited deals, what were those returns? How those returns compare to what they originally underwrote? Now, that'll tell you how conservative they are with underwriting too.
Yeah. So I think the biggest thing that I would tell investors, potential, current, and recurring is if an investor doesn't understand an answer, that's not a red flag, but not asking a question is not asking the questions that you need to ask or not understanding what you need to ask. That's the red flag. Now, if you don't understand the answer, it's on your representative that you're talking to explain that in language that you understand. Like you don't sound smarter. And this is mostly to IR reps and to investors, but like you don't sound smarter by making things sound more complicated. Our job is to make things as cut and dry as possible and as understandable and digestible as possible. The second thing is don't be afraid. Don't put something into ChatGPT and just ask a list of 50 questions to sound smart, especially if you're a first time investor. That's fine. Like if you don't have a list of questions, use this list that we're providing you, or talk to other people that have invested, or like you said, just ask, what are some questions I should be asking that I'm not
Yep.
asking? What are other investors asking when they hop on these things? How do I know that this is a good deal? And then if you have already asked the questions and vetted the operator, that should be a sign of trust that you are asking them those things, and they should be able to tell you, these are the things that people typically ask. These are things that other people ask. This is how you would evaluate this deal. And then you'll know from going forward. Obviously, experience is the best teacher.
Yep.
Again, this is not a comprehensive list of questions, but I think the biggest thing that I would say to people is like good deals can survive tough questions and weak deals can't.
Yeah, I agree. That's a great one. Good way to end.
Perfect. Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.